I've been trying to understand what normal actually means, what the post-COVID world looks like when we say normal. In a bond market that yields about 85 to 90 basis points on a 10-year Treasury yield over any given day in the last week, is that normal? Is that the new normal that we might have to live with even with a vaccine?
Yeah, who knows if it's a new normal? It's at least something like the new normal. I do think, and previous guests were talking a little bit about Fed policy. I think where Fed policy is going to really be impactful is if they try this average inflation targeting concept and continue with it as we see a cyclical recovery, hopefully see a cyclical recovery into 2021. Post a vaccine, markets start to take off, and the Fed said, look, we're going to keep real interest rates low. We want higher growth. We want higher inflation. Then maybe you see a sell-off at the back end of the bond market, but the Fed trying to pull down the front end. So probably not normal, but I think that's the Fed's policy MO from here.
Isn't that fuel for the growth trade in the equity market, Eric?
Is that enough for the growth trade in the equity? I mean, you'll probably see a rotation.
Is that fuel for big tech? Just given the story that we've seen in the last few months where real rates and low real rates have been at the epicenter of the valuation story around big tech. If that's the Fed's game here, does that keep you on the road to having a constructive view on that part of the market?
Yeah, so look, certainly a big part of the rally that we've seen in big tech is not only people work from home and using Zoom and things like that, it's also these low interest rates, which is not only the Fed, it's market forces. But if we do see a cyclical recovery, it'll probably be more of a rotating equity market into value stocks, into emerging markets, into non-U.S. stocks, and away from some of that big tech. But as long as rates stay low, for sure, that's going to help assets where most of the value is in the future as opposed to closer to the present.
And rates are staying low. It reminds me of the Soros quote, or at least I paraphrase, that markets can shape the events they anticipate. And in the credit market, that really is true. In credit, Eric, that is so self-fulfilling that if investors believe the future is good and keep credit bid, then the future might well be good because credit is bid and that keeps the optimism of the C-suite buoyant. It keeps financial conditions loose. And last week on Friday, to see that Carnival offering come to market the way it did, to see Inspire Brands come to the loan market the way it did, Eric, does that keep you in a constructive mood when you see the primary market doing so well?
Yes, no, I think that's a great question. That credit markets, there is some reflexivity, to use a term that George Soros uses. That if people are positive and investors think companies can pay back their debt, that means rates will be low. And if rates are low, it makes it easier for them to pay back their debt. Obviously, lots of discussion last week with the Fed's, some of the 13.3 programs coming to an end with the announcement from Secretary Mnuchin. So lots of discussion among people on that. But generally speaking, where spreads are, where absolute yields are even lower, just because the low base rates that we were just talking about, that makes credit conditions easier for everything.